Hello again traders, doing your there from Drfx, swing trading mentoring. Gonna be taking a look at the pound Aussie dollar trade, which unfortunately resulted in a trading loss, and speak to why I will no longer be focusing on trading targets that are more than 70 pips, that target trading gains using a holding period of more than 2 days, because of the fact that we have a lot more profitable trading opportunities that are available within a 24-hour period by targeting trading gains of between 30 and 70 pips. So that is going to be the focus from now on, because trading and looking at larger pip movements generally going to be a waste of time, to put it bluntly, compared to the other short-term movements that generally are better, more frequent, and provide us with a faster turnover, and in many cases require a smaller stop loss. So it definitely looking like the better option in terms of the focus going forward. And so this is going to be the last discussion of a trading opportunity, a trading setup that targeted more than 70 pips. So this is basically the focus of the strategy. This has always been a part of the new approach that I've been using since February of this year. But towards the end of the year, or towards the middle of the year, I started looking at the possibility of adding the moves that offer between 70 and 100 pips. But that sort of distracts the focus, and a lot of times what happens is that I try to justify setups that aren't that much of a high probability setup. So in other words, they would be a risky setup, but I would try to find a way to justify it, unknowing to me, until I realized that the trade was a bad trade, just for the sake of trying to get a larger pip turnover. But in trying to get that larger pip turnover, there are shorter term moves that have better setups, where you can be a lot more objective and capture more of these trading gains on a regular basis that can provide us with faster turnover. So this is going to be the heart of it. And as I said before, what I've realized is that even though the heart of this methodology is to capture between 50 and 70 pips, there are actually many other opportunities that offer between 30 and 50 pips as well, with strong setups on the 4-hour chart and the daily chart. So those are going to be incorporated into this main strategy, where the focus is going to be the shorter term moves that are better in terms of the overall setup and in offering faster turnover. So this was a setup and expectation for the pound Aussie dollar, where I thought that the market was actually going to be forming a consolidation setup, and that this was a signal to get things going bearish once again. This was a setup on the 4-hour chart, where the expectation was that the market was going to continue towards this area here. And essentially, this was a signal to indicate that we should start trading and look forward to a trading gain in this direction. This was supported by the fact that the market had provided a small ABC setup, which normally indicates that the market is going to be moving quickly. And this was a setup to take advantage of this trade, with a stop loss placed above the downtrend line that was formed as part of this downtrend. However, as you can see, unfortunately, the market rallied and took out this candle here with this bullish signal, and took out the stop loss in the process, leading to the trading loss. So what I think, one of the reasons why I think this was a mistake was that I thought that the market was going to be breaking out in terms of single candles like this. But for these situations, if the market is actually going to be breaking out in terms of these types of single candles, then it would mean that we'd have to wait until the market provided a second candle. So in other words, if in the absence of a candlestick formation like this that started the move, this overall was a U-turn, but it wasn't a bearish candlestick formation because of the fact that we had these two candles here, and this candle was much too far away from the start of the U-turn. So it wasn't much of a signal by itself. So what would be needed is to have confirmed that the market was going to be continuing and breaking out in terms of single candles. Entry would have to, the market needed to have provided us with a second bear candle. So the second single candle would indicate that the market is going to be breaking out in terms of single candles, and entry would take place at that second entry candle, at that second single bear candle. So I think that was a mistake, in addition to the fact that even though this was a mistake in terms of the entry, the loss would not have been as large as it was, because we would have been able to exit the trade at this area here. This was the entry candle. So 1, 2, 3, 4, 5, 6. At the end of the 24-hour holding period, this would have been the trade. This would have been where we would have exited the trade at the close of this bear candle. So it would have been a small loss of probably just of maybe 5 pips compared to this large loss that was incurred as the market took out the stop loss. So another reason why holding trades for longer than 24 hours is risky, because in most cases, if the market is going to be going towards its 30 to 70 pip target, it will do so within 24 hours. So there's no point in holding on for more than that, because it increases the possibility that the market will stall and reverse. If it hasn't shown any indication that it has responded to the signal that we had traded and is just moving sideways, then in most cases it is going to indicate that the market is not going to be going towards our target and could actually reverse. So unfortunately this led to a trading loss, but the somewhat bright side of this loss is the fact that it confirms to me that this sort of approach is not a viable option compared to the shorter term moves that provide us with more frequent opportunities and better setups and faster turnover. So this is going to be the last trade that attempted to capture a trading gain of more than 70 pips. If I'm going to be doing that, it's going to be on a demo account, probably in a Dukas copy trading competition. But on my live account, no longer going to be trying to capture these larger targets. So aiming for more than 70 pips over 2 days is really unproductive, because as you will see in a while, had we closed that trade on the pound Aussie dollar within 24 hours or not traded it any at all, we would have been able to identify a trading opportunity on the Canadian Swiss franc that offered a better trading option in moving by 35 pips within 24 hours. And of course, what you could do with these smaller targets is to actually increase your volume, so that the rate of return for that type of trade is equivalent to what you would have got if you had captured a trading gain of 50 or 60 pips on a single trade. So I'll take a look at that in a little while. But in summary, this is the last trade. This was risky, and this is a lesson in terms of focusing now on the shorter term opportunities provided by the currency market. Euro pound is actually forming a consolidation setup on the 4-hour chart. This was what I had seen a couple of days ago, where the expectation was that the market would rally in response to this double bottom formation. And this is exactly what started. And it continued to where we are now, where it U-turned. And looks as if it has formed the second resistance point as part of the formation of this resistance boundary. So this is possible in terms of a signal. This is actually where the price is right now. And I drew this line here as a possibility in terms of the signal that would essentially be an ABC signal that would take us rapidly towards the support point, where it could then form the second support point to form the support boundary. So this is the example here, an ABC signal where the market would essentially be providing us with this. This would what would be needed right now. This bear candle that would complete the formation of this ABC signal, and that would take us towards this area here. Moving on to the Euro Aussie dollar, which as you recall is either going to be forming was looking as if it could form either a false breakout reversal setup or a large consolidation. This was a setup a couple of days ago where the market had formed this range setup and was hovering below the support boundary, and had shown that one of the possibilities was that the market could actually be heading back inside of the consolidation with an ABC signal, or it could actually U-turn and provide us with a bearish breakout as part of the formation of a larger consolidation setup. But as you can see here, the market has actually formed a double bottom formation, and this is the current candle that is open. So we're going to need the market is going to need, this is going to close within the next 16 hours. So if this closes with a strong candle, then it is confirmation that the market is heading back inside of the consolidation and is going to be taking us back towards this resistance boundary as part of the false breakout reversal. So the first part of this signal has been given, the double bottom formation. So confirmation is going to come with a strong bull candle that closes above the support boundary. Aussie US dollar was shaping up to provide us with a false breakout reversal. This was a situation a couple of days ago where the market U-turned bullish and closed just below the support boundary. And this was shaping up to be a false breakout reversal that would take us back inside of consolidation. And this is exactly what has taken place so far. The market has broken above support, but it has done so with these small candles. So not a very convincing signal yet in terms of starting to buy and head towards resistance. Another red flag is that this 4-hour chart appears to be overbought, because we have had so far as part of this uptrend 1, 2, 3, now potentially a fourth setup. And as you know from the 3-wave rule in the trading manual, after the market has formed 3 or more setups as part of a trend, it generally increases the possibility of volatility and a reversal in a short term, because the market generally loses its momentum after 3 or more setups. So this is what we're seeing here on the Aussie US dollar, where it's now possible that the market could be forming a double top formation here that breaks this uptrend line and possibly breaks below the support boundary once again. And this could actually lead to the formation of a consolidation setup, with the market breaking bearish and then rallying and then providing us with additional waves as part of the formation of a possible consolidation. Now the Canadian Swiss franc is the example of one of the short-term moves that are actually profitable compared to trying to hold out for the larger gains beyond 70 pips. So this was moving within a consolidation setup on a daily chart in the form of a pennant. And what took place at yesterday evening, this would have been at 9 o'clock Eastern Standard Time, and this was a signal that was given at that time, somewhat of an ABC signal with a strong bearish candle here, and the target would have been set for the area at the support boundary. So this would have offered a trading gain of approximately 35 pips from the close of this candle, and the stop loss would have been around between 25 and 30 pips. And so this would have been a trading opportunity. And as you can see here, after 1, 2, 3, 4, 5, 6 candles, 24 hours on the dot, the market hit the support boundary. It actually hit the boundary at the 5th candle here. So this would have potentially provided us with a trading gain of 30 pips, 35 pips, had we entered it and taken advantage of this signal here. So within 24 hours, this trade provided a trading gain of between 30 and 35 pips. And depending on how much risk you use on this trade, that this return could have been equivalent to, it would depend on the size of your account and your leverage, etc. But on average, it could range from between 1% to 4%, depending on how much volume you would have used on this trade. So with these smaller trades, you can increase the volume so that you can still remain within your risk return parameters. And the rate of return that you would have got from this would be the equivalent of what you would have got on a good 50 or 60 pip, on a 60 pip trade. So this would have been equivalent, this could be the equivalent of 3%, 4%, or maybe even 5%, depending on how much risk you take per trade. So the stop loss would have been just 25 pips. So you could have increased your volume on this trade and maximized on the potential return that this trade could have offered. So in summary, the pound Aussie dollar unfortunately led to a trading loss as the market rallied instead of continuing bearish. Two main factors that I conclude from this loss are that, one, the signal that was given was not enough. We should have waited until I should have waited until the market gave a second bear candle, single candle, and so entry at that area was a little too early and too premature. And the second reason is that aiming for these larger targets, you tend to overlook. What you also do, you tend to not only miss the shorter trading opportunities, but you also tend to overlook some traps or mistakes that you're actually going to be making in trying to go after those larger targets. So as I said before, the mistake that was made was that I should have waited until the market gave a second bear candle to confirm that the market was going to be breaking out in terms of single candles. So it's things like this that I tend to overlook when I'm trying to aim for larger targets. But with shorter targets, your vision is a lot sharper, and you're better able to identify and distinguish between risky setups and profitable setups. Because the larger moves of 70 pips and more are infrequent but attractive, there's a feeling that you don't want to miss it. So because of that, there's a temptation to want to overlook certain traps and certain red flags. But with the shorter term moves, what happens is that because there are a lot more of them each week and each month, you can be a lot more objective and be a lot more selective. So you're less likely to make mistakes compared to trying to aim for the larger trading moves. So that is the issue with regards to me trying to target these larger moves instead of sticking to the ones that have worked before and taking advantage of them on a regular basis and maximizing on the rate of return that they actually offer. So this is going to be the focus, 50 to 70 pips with occasional 30 to 50 pips, so long as the signals are strong enough, such as what we just saw on the Canadian Swiss franc. So moving forward, this is going to be the focus, and no longer going to be looking at the targets of more than 70 pips. So if you have any questions, you can let me know. And the euro pound is going to be the one that could present a trading opportunity. So I'm going to be looking at that one, and as well as the possibility on the euro Aussie dollar that could also be providing us with a trading opportunity, as it heads back inside of its consolidation.